please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The government's 5-point plan did little to calm the nerves on the FX street. The rupee went on a roller coaster ride. Once again, all emerging market currencies, of course, were under pressure. But the rupee had a cocktail of good news with lower crude oil prices and a weaker dollar, along with those 5 points announced by the government on Friday. Even then, there was no respite for the rupee. So what were the pressure points? Well, first up, there was significant appetite from importers. So at all lows, you saw importers coming in and buy. That is at 72.40, significant importer buying. The government too was seen to be alert with announcements every now and then, and especially every time the rupee fell towards the 72.70 mark. Separately, bonds also were sulking, despite the RBI announcing that it will purchase bonds in open market operations. Hence, you could see the impact on equity markets as well. So why did the government's 5-point plan fail to lift sentiment? The move on FPIs and masala bonds were actually seen as unhelpful. So a bulk of the announcements required foreign funds to invest in rupee-denominated bonds. That they would do only when the rupee stabilizes. The other part that was uncomfortable for many economists were the external commercial borrowings under 1 year and unhedged infrastructure loans. Both those proposals were seen as downright irresponsible, not the way you should be bridging current account deficit gaps. And finally, of course, markets are also waiting for more announcements from the government, probably a separate window for oil importers so that the bulk of dollar demand is at least out of the market. Also, import curbs. And we did get some indications from the government that there will be steps to curb imports. Maybe less about exports was spoken today, but we did get hints that import curbs are going to be announced in several sectors. And of course, NRI bonds is something some people are waiting for, but most economists and people in government also say this is perhaps on the table, but last in the pecking order. Well, finally, the rupee has been, of course, one of the worst performing currencies if you looked in 2018 with a 13.5% fall compared to most of the others. But I just want to draw your attention to the 5-year performance. That is since the terrible September of 2013. Since then, the rupee has not fallen much, 12.5%. As you will notice, all the 5-year fall of 12.5%, all of it has come only in 2018. And that's why the rupee looks terrible. It didn't fall enough in previous years. And that's why it looks bad in the current year. Actually, we should go further down. Beyond the yuan, let's go and look at other currencies like the Malaysian ringgit, the rand, the rupiah, and the Turkish lira. You will notice that, their 5-year performance is pathetic. Compared to that, the rupee comes out doing very well. The only thing bad about the rupee is that its entire fall of 12-13% has happened in 2018. It has been a remarkably stable currency from 2013 to 2017. Well, with that, let me invite our guests. We are being joined by A. Prasanna, the Chief Economist at ICICI Securities Primary Dealership Unit. We are joined by Vivek Rajpal of Nomura India, and also by Alvin Tan of SocGen. Gentlemen, thank you very much for joining me. Well, Vivek, what's your sense? None of those steps announced made much of a difference today. The rupee opened gap down, stayed that way?
Right. And I think, as you pointed out earlier in your introduction, most of the measures fell short of expectations. In the sense that, to a certain extent, there were high expectations as well, which got unwound. To be frank, it appears that this is just the first step of measures. And so we have to see another round of measures if they come through. But one point that I would like to make here, along with the very good introduction that you made, that at the moment, the currency depreciation is largely driven by the global factors and not local factors. And hence, policymakers' template is a little bit different than what it was in 2013 when it was driven by quite idiosyncratic factors.
Okay.
That's one point that I would like to
Fair point, actually. On that note, then let me invite Alvin Tan of SocGen. Alvin, you know, the government tried to make some positive noises in terms of trying to bridge the current account deficit gap through some easy debt flows. It also tried to raise the window of foreign investment in rupee-denominated bonds. All that has not really added up to much today. Are we just, is the rupee going down only because of a global force, or is it in particular getting targeted for its current account deficit?
Hi. Well, definitely the global factor, I think, is the key one here. As you mentioned about the measures that were announced today, many of them presume there is appetite by global investors for rupee assets. Unfortunately, at this stage, animal spirits among international investors for EM assets, and that includes rupee assets, are quite weak. And so I think this global factors will continue to dominate the situation. As you mentioned, though, India's situation is unhelpful in the sense of a persistent fiscal and current account deficit, and oil prices are also elevated because of the Iranian sanctions coming up. So all these, the combination is negative for rupee.
Alvin, you know, do you think that this rockiness continues for a goodish bit for emerging market currencies? It's not just India which has announced some steps. They're more cosmetic, not very structural. But other emerging markets have announced large interest rate hikes as well. Despite that, we have not seen much of an end to the emerging market currency fall. Is the worst over, or will this, you know, painful fall continue?
I think, unfortunately, over the near term, in our view, over the next 1 to 2 months at least, I think the pain will continue from a combination of global macro factors. The first is that the Fed is continuing to hike. In fact, in the past few weeks, we have seen a significant market pricing of a December Fed hike, so a fourth Fed hike for the year. So that has definitely contributed to the persistent pressure on EM currencies. And on top of this, the fact that US-China trade tensions appear to be worsening. So these are the two global macro factors definitely to look out for. And unfortunately, in the near term, the prognosis is not particularly positive for EM currencies.
Okay. Let me come to the rupee in particular. And we have the economist joining us, A. Prasanna of ICICI Securities Primary Dealership. Prasanna, you know, you put out a very exhaustive note on how, in any case, our current account deficit has not been well serviced. It got camouflaged because of lower oil prices from 2015 to 2017. But really, exports have been falling short for a goodish bit. In your sense, how much of these announcements by the government, you know, the rupee bond, the FPI, foreign portfolio flows into rupee-denominated bonds, the ECB flows, all this, how much can it bring in terms of flows?
See, first of all, I think the way they're going about it, I think it's very poorly conceived and managed, I should say. I mean, you don't keep dripping out news like this, that there are going to be these meetings, there are going to be these announcements. And then, like Vivek said, I mean, you build up this whole expectations in the market, and then you inevitably you fall short of those expectations, right? So you decide what you want to do, and then you then come and announce it in one go. Take the markets by surprise. I think that's the rule number one. Now, the second point, like you said, is, I mean, you are trying to attract capital flows when actually the sentiment on EM currencies is negative, the sentiment on rupee is negative, the sentiment on India is turning lukewarm because of general elections next year. So in this kind of environment, to expect investors to come in, just because you cut the withholding tax or you kind of loosen some regulations, I think that's a bit far-fetched. And of course, I mean, like you pointed out, the fundamental problem is the current account deficit. You are not doing anything concrete to address it, and of course, it's very difficult to do it in a very short order of time. Okay. So I guess the point is to realize that none of your options are palatable, right? I mean, you probably have to choose the ones which are more palatable than the rest. That's all. So you have to make some hard choices. You cannot postpone that. Yeah. And I was a bit disappointed that on the fiscal deficit part, I would have thought they should have been a bit more unequivocal. I mean, committing themselves to the fiscal trajectory, to say that they won't borrow extra. I mean, some really hardline statements could have come out on that. If they are committed to
not enough that they said that they will stick to 3.3%. I mean, the Prime Minister himself saying that.
I would preferably I would prefer that if they said they're not going to borrow extra. Okay. I think that really would send the message across.
Okay. Yeah, considering that the second half has a larger borrowing program, that would be helpful. But Prasanna, you know, the fact that the currency itself has corrected a goodish bit, 13% year to date and about 5%, I think, this month or the last 4 weeks. When will this have a correcting influence on the trade deficit? Obviously, August was almost as bad as July, but we should start seeing the impact in September itself, you think? And that will have a salutary impact on sentiment?
I mean, it's difficult to say whether in 1 month itself you'll see an impact, of course, because obviously some of these are all orders which have been contracted quite some time back, right? So it's not that the prices also change so quickly, so it will take time. But broadly, if you ask me, I think if you take a 3 to 6 month period, definitely we should start seeing the changes. But then the corollary of that is of course that you allow those price effects to flow through in the domestic economy, right? Fuel being a prime example. Yes. So this is what I was meaning by saying there is a cost to be paid, and you have to bear that cost. So you pass through the higher fuel prices. I mean, the proportionate rise has to be passed through. Yeah. And then it will have an effect on demand. Yeah.
Well, they've at least stayed the course on fuel prices, you will have to say, because that's the only way, I suppose, you can dampen fuel demand out of India, control aggregate demand. But I'll come back to you on the cost of capital and interest rate hikes expected from the Reserve Bank. Vivek, exactly the question I asked Prasanna on trade, I want to ask you on the capital front. Will there be a point at which the rupee has fallen enough, bond yields have risen enough, that just make foreign portfolio investors attracted to come in? Or for that matter, shares. I mean, shares is more complicated since yields are rising, the valuation should be coming down. But at some point when both shares and rupee fall, they should be attracted to foreign investors, isn't it?
That's a very fair point. But I think there are two preconditions which are required on this front. One precondition is that INR's pace of depreciation or INR's performance related to other EMs should improve. If its pace of depreciation declines, then probably one can think of in terms of carry, because at the moment carry per unit of volatility is actually very low despite higher yields that we are seeing. So pace of depreciation needs to decline. And number two, EM sentiment needs to get better. So it's just not about correction in rupee assets. I think, as I said earlier, it's more a global-driven kind of a phenomena. So probably EM as an asset class as a whole needs to get into a better valuation, and then one can look for a intra-EM kind of a trade where India can benefit.
Okay. Well, the last time taper tantrum, I think, began on May 22nd, and the tantrum went on till, I think, August 22nd or even end of August. So that's 3 full months that the tantrum lasted. How long will the Trump tantrum last? That question to our guests in a minute after this break. Welcome back to our special show, the Rupee Roller Coaster. We have been speaking with Alvin Tan of Societe Generale, Vivek Rajpal of Nomura, and A. Prasanna of ICICI Securities Primary Dealership Unit. Gentlemen, thank you for waiting by. Alvin, the point that Vivek was making, that even if Indian bonds look attractive at an 8.2% yield and the currency having depreciated 13% this year, we will still be a victim of the EM sentiment. What's your take? At some point, foreign investors will find this combo of high bond yields and currency depreciation attractive. Is that near, or is that a goodish bit away?
I think it's probably still a bit away, maybe next year, but we need to really stop this route in EM first. Foreign investors at this point are not particularly keen on re-entering. I think it's fair to say that EM assets as a group have been heavily punished this year, pretty much across all the asset classes, equities, bonds, and currencies. So I think it's also fair to say that value is emerging in some pockets of these asset classes. But at this point, sentiment rules. And really, I think what you need to look out for are, again, the two main issues I raised in terms of the global factors. So first of all, is we need to see this market expectations of where the Fed is going start to level off and perhaps maybe even reverse. And that could happen if we do see momentum coming off the US economy, perhaps early next year. And beyond this, we need to see some movement, some positive news about the US-China trade tensions, which are having a global impact.
Okay, Prasanna, I wanted to come to you about the arithmetic or number on the rupee that comes close to its long-range valuation. I mean, we have been quoting numbers to say that from 2014 to 17, the rupee didn't depreciate enough. In fact, it was appreciating. At what point does it, come close to its long-term valuation?
I mean, well, if you use RBI's 36 currency RER, so probably we are still another 6-7% away. Oh. I mean, that is of course ceteris paribus, right? And that never happens. And I think this is the point we have made when every other currency is depreciating. For that at that time to look for a correction in real effective exchange rate. Okay. I mean, it means that you have to really. I mean, your currency has to be the worst performer to achieve that, and that is not a position you want yourself to be in.
Correct. Okay, well, that's a fair point. But nevertheless, is there a range that you are looking at? What should the markets be prepared for? 73, 74?
I mean, well, see, I mean, just purely going by the kind of commentary coming out, clearly the policymakers are concerned, and then we have seen the pace picking up over the last couple of weeks. So I would say this broad range of 72, 73 is where, I mean, tactically, I would say is where it should stop. I mean, if government is taking these steps, one assumes, and based on whatever one can see in the market, RBI has also stepped up its intervention. So I would be very surprised if they allow it to kind of breach this kind of bracket, unless we have some really surprising global developments. I mean, something completely unexpected. Otherwise, I would say broadly, this is the range we're looking for Rupee to hold for some time now, at least. Okay.
So we hope that the 72-73 range for now holds, going by government behavior and Reserve Bank intervention. Vivek, what's your sense about what may be the rupee range?
Well, I mean, I would tend to agree with what Prasanna was saying. But I am a little more skeptical in terms of that they will try to hold any range. I think ultimately it depends on whether the rest of the EM currencies are depreciating. My only hope is that whatever they will do, they will ensure that the pace of depreciation is slow and rupee is not the worst performer. I mean, rupee comes in somewhere in the middle of the pack. From that perspective, probably near term, we may consolidate around those levels, but I think over a medium term, if rest of the universe or rest of the EM universe is depreciating, probably that's the path of least resistance.
Okay. Well, Alvin, is there some external event that can bring some stability? Say if Trump were to stop announcing further imposition of tariffs, at the moment, the US is not worried about the EM slowing down. But some economists say at some point in time, even the US growth will be impacted if it continues to punish EMs with higher tariffs and therefore slower growth. Do you see any event in the global, in the global scene that might stabilize the EM route?
Well, yes. I mean, in the near term meaning in a matter of days, we will know indeed if the U.S. is proceeding with these new tariff measures on 200 billion of Chinese goods. So that's the near-term thing to look out for. If indeed the administration goes ahead with this and then China retaliates, that tells you that the sentiment globally, particularly for EM assets, is likely to worsen. Now, beyond this issue of what's happening with U.S.-China trade relations, as mentioned, the path of the Fed is very important. And indeed, one reason why the Fed has not really laid off from further tightening, in fact, raising the pace of tightening this year, is that U.S. markets have been largely unaffected by this EM sell. I mean, S&P 500 index raised to an all-time high just a few weeks ago. So long as this momentum in U.S. assets continues unabated upwards, the Fed is not going to slow down.
Okay, yes, that's true. Last time around, Ben Bernanke could oblige the EMs. This time around, I guess the Fed cannot because the inflation levels are rising. Very quickly, Prasanna, what would you say as good behavior that can influence markets? Something from the RBI on October 4th, even earlier, September 28th, government borrowing program, anything that can be a salve?
No, so yeah, like on the government borrowing program, like I said, I think they should categorically say that they're not going to borrow extra. In fact, in the first half, when they announced, they said they've cut the borrowing by 50,000 crore. Yeah. So they should stick to that and then say that they're not going to borrow extra. Of course, on fiscal deficits, I've long been a critic. I do think the current targets themselves are wrong. So we need lower targets and lower fiscal deficits. I don't know, maybe in the election year whether that's possible. From RBI side, I mean, the RBI has been saying they're an inflation targeting central bank now. So currency is not going to be a number one priority. Yeah. So we do expect on a base case for RBI to hike the repo rate by 25 basis points. So they should just stick to that message, and I mean, their actions, at least on the RBI's part, show that they're not that concerned by rupee's movement. So I guess the language should reflect that.
Okay, well, they could do that since they have not spoken at all since the rupee started falling. October 4th, the Reserve Bank's message will be important. Its talk on the rupee, but much more important, a rate hike also will mean curbing consumption to some extent. And that, of course, can have and will have its impact on imports as well. We'll have to wait and see. There are leading events, but much more so, we have to look at the global scene. And that's not very promising at this point in time, as Alvin Tan has been telling us. Alvin, Prasanna and Vivek Rajpal, thank you very much for joining us on this special show. Our experts believe that we are probably going to consolidate at the 72-73 mark for now. But as all of them point out, the global scenario is still extremely skittish. So we could be vulnerable to anything that can happen to the EM basket as a whole.